Financial securities. Financial securities could be classified broadly into money markets and capital markets. Main characteristics of money market securities: they are short-term, marketable, liquid, and low risk. Capital market securities, on the other hand, are characterized as longer term and riskier. Money markets might include the following securities: treasury bills, certificate of deposit, commercial paper, banker's acceptance, euro-dollar, repos and reverses, banker calls, federal funds, and LIBOR market. Treasury bills are the most marketable of all money market instruments. Treasury bills represent the simplest form of borrowing. The government raises money by selling bills to public. Investors buy the bills at a discounted price from the stated maturity value. At the bill's maturity, the holders receives from the government a payment equal to the face value of the bill. The difference between the purchase price and the treasury bill maturity value represent the inventor earnings or profit. This is a sample how financial press reporting the prices of treasury bills. Asked price is the price that investor would pay to dealer. Bid price is the price that investor would get by selling the treasury bills to dealer. The difference between bid and asked price is called bid-ask spread and represent dealer profit. How we could read these data? Let's take treasury bill highlighted which mature in 9th of September 2004. The asked price, which is the price paid by investor to acquire this security, is 1.24%. Since the percentage is annualized, then we need to know the price and maturity, which is 91 days. So, 1.24% multiplied by 91 divided by 360, and that equal to 0.3134%. So a bill with a $10,000 par value could be purchased using this formula. $10,000 multiplied by 1 minus 0.3134%, and that equal to $9,968.66. The bid price, which is the price received by investor to sell this security to dealer, is 1.25%. Since the percentage is annualized, then we need to know the price and maturity, which is 91 days. So, 1.25% multiplied by 91 divided by 360, and that equal to 0.316%. So a bill with $10,000 bar value could be sold using this formula. $10,000 multiplied by 1 minus 0.316%, and that equal to $9,968.40. In conclusion, the ask price calculated as $9,968.66 and bid price calculated as $9,968.4. Hence, the dealer profit is the difference between ask price and bid price, and this is, in this case, will equal to $0.26. The investor received the bar value at maturity, which is $10,000. So the profit for the investor will be the difference between the bar value and the purchased or asked price, which is in this case $31.34, and that's in 91 days. The profit of investor of $31.34 divided by the initial investment, which is the purchase price or the ask price, equal to 0.314 in only 91 days. Multiplying by 365 divided by 91 to get the annualized percentage, and that will be equal to 1.26%, which is the real annualized return, and that equal to the asked yield price in the last column, and it's also called Treasury Bill Bond Equivalent Yield. Certificate of deposit is money deposited in the bank for a certain period of time. The bank pays agreed interest at the end of the fixed term. The investor should not withdraw any money of the deposit, and if that required by the investor, then heavy penalty might be applied in the form of not paying the interest to the investor. Commercial paper is a type of loan used by corporations taken from public directly. Corporations issue commercial paper to public with a stated maturity date and agreed interest. Commercial paper can be up to 270 days only. The yield on commercial paper depends on time to maturity and credit rating of corporate issues the commercial paper. The idea of banker's acceptance starts with an order from customer to the bank to pay a sum of money at future date, typically within 6 months. When the bank endorses the order for payment as accepted, the acceptance is the responsibility of the bank to pay a specific amount of money to the holder of this paper or security. The bank acceptance can be traded in secondary market just like any other asset. Acceptance can be sold at a discount from the face value of the payment order. Euro dollars are dollar-denominated deposits at foreign banks or foreign branches of American banks. Despite the tag euro, but these deposits could be anywhere in the world outside USA. Euro-dollar certificate of deposit resembles domestic bank certificate of deposit, except it's the liability of non-US branch of the bank. Repurchase agreement is an overnight borrowing. The dealer sells securities to the investor with an agreement to repurchase them next day with a higher price. Repos is exactly like repurchase agreement, but with a time frame of 30 days or more. Reverse repo is the mirror image of repo. Here the dealer finds the investor holding government securities and buys them with an agreement to resell them at specified higher price on a future date. Individuals who buy stocks on margin borrow part of the funds to pay for the stocks from their broker. The broker in turn may borrow the funds from the bank, agreeing to repay the bank immediately on call if the bank requested. The rate paid on such loans is usually about 1% higher than the rate of short-term treasury bills. By law, banks are required to deposit certain percentage of the total bank deposits directly in Federal Reserve Bank or Fed. This percentage is called federal funds. At any point of time, some banks may have extra funds deposited with the Fed and others might be in short. In the federal funds market, banks with excess funds lend to those with a shortage. Those loans, which are usually overnight transactions, are arranged at a rate of interest called federal funds rate. London Interbank Offer Rate is the rate at which larger banks in London are willing to lend money among themselves. This rate becomes the premier short-term interest rate quoted in the European money market and serves as a reference rate for a wide range of transactions. Capital market can be further classified into bond market and equity market.